Welcome back. Today we're going to be talking about in particular the UK stock market and potentially the end of dividend investing. There's a lot of news here, or my thoughts and commentary based on my limited studies in accounting and what I feel of the latest budget, but we're going to skip past a lot of the political crap, right? And obviously this seems a bit like a clickbait title because views are at an all-time low, but I'm trying to add more value than before. So if you believe that this video has more value for you, then please drop one of these to help beat that YouTube algorithm. It is much appreciated. So first things first, what has actually happened in the autumn budget? Well, there's two key things to be paying attention to that aren't really native to any business in particular. Now that is the change in dividend tax allowances and also capital gains tax allowances. Now these are quite big deals for investors because a lot of people park their money here to get these shelters and be tax-free for a certain amount. In particular, if we look at the dividend tax allowance, which is going to be decreasing over the next few years, you can see that through 22 to 23, the current financial year, we've got a dividend tax allowance of £2,000. This halves next year, and then halves again the year after. Now, they've said before that this is still a very generous tax allowance. However, what it's basically saying here is it's devaluing dividends overall. However, dividends still remain advantageous. Now, in particular, this applies to those people that have set up a limited company or private limited company and you're paying yourself an income via the form of dividends. Because if you're in the basic rate of taxpayer, your income tax band is only 8.75%, and therefore it works out cheaper to pay yourself a dividend income than it does anything else. However, UK stocks, especially the FTSE 100, right, we have these chunky dividend payers. So now the idea here that you're getting less of a dividend tax allowance makes these companies less advantageous, and these dividends are going to be seen as less useful to investors. Now I can see why they've done this, right? Because if you wanted to also encourage the behavior of companies to pay out less dividends and perhaps invest more in themselves, then you obviously make the dividend tax rates a little bit more unfavorable and the tax allowances shorter, and obviously they're raising money for their budget in this regard. Now, they've also done this to capital gains allowances, which I'm not really a fan of here because I felt that this really wasn't a huge impact, but really has changed here. So what they've done here is they've halved it next year and halved it the year after. So the current capital gains tax allowance of this financial year is £12,300, right? That's very generous. That's good. Again, you're not going to be making serious money, but it gives you some room, right? Many people aren't even going to reach that, and the people that do, again, it's not that big of a deal. So I understand here that it going to about 6,000 is fair enough. But to then half again to £3,000 in 24 to 25, that's quite an extreme measure. Basically, what it's telling us as investors is that perhaps we shouldn't be investing here and that we should be saving our money instead. Now, I get the idea here. We want to be spending a bit more money. We don't want to necessarily be putting it in these assets. I could see why or what they're pushing for here, but I don't think this is the appropriate method. Instead, I believe, whilst yes, you could be slashing down the allowances, and again, this is more or less talking on their policies here, you could slash down the allowance on capital gains tax here, but ideally what you'd want to do is incentivize long-term capital gains or long-term investing, right? So that the longer the period that your investment lasts for, the lower the tax rate is. Now, of course, this is going to reduce their overall income through capital gains tax, but that would be a great way to incentivize long-term investment in a company that is struggling at the moment to actually generate investments in the economy, and it's probably one of the reasons why we are struggling quite a lot here. Now, again, I would probably even cut dividends further. I don't feel that dividends add that much value. Of course, they do to an investor, but overall, I don't think they're as important as capital gains. Now, of course, I'm biased. I'm young, right? I'm only 22 years old, nearly 23 now. Of course, it doesn't matter to me because I'm not trying to draw an income in dividends. So I understand completely that you guys are going to be against that. I just don't feel in terms of overall value that it is worthwhile, and I would in fact increase this basic dividend tax rate, and it's going to piss off a lot of people that have got private limited companies that are paying themselves a dividend, but at the end of the day, face it, like if your business, your private limited company is capable of, generating that level of money and you're able to pay yourself that much as a dividend, you're likely trying to take advantage of it and you likely already make quite a decent chunk of money. That said, again, this is just policy and how I would improve it, but this is politics, right? And you know what? Overall, fuck politics. It's boring. It's not worth your time unless it impacts one of your investments. So what I'm saying here is, what can you actually do to protect yourself? Knowing that the dividend allowance is going to be quartered, right? It's going to be slashed by twice. I don't know, I lost myself on the maths there. Knowing that dividend allowance is going to go from £2,000 to £500 in 2 years' time, and the capital gains allowance is going to go from £12,300 to £3,000 in 2 years' time as well, what can you do to protect yourself as an investor? Well, in the stock market, you can obviously avoid the stock market, park your money elsewhere, park your money in perhaps premium bonds, or is it NS&I income bonds, which I believe aren't taxable. I would have to double check that, but the interest rate is so low, it's going to be the risk-free rate here, and it's going to be effectively the rate what is it? I can't remember the right term here. I've just been studying this. My mind is fried. But basically, it's going to be the base rate that is set by the central bank, and that's how much it's going to pay. It's probably not worthwhile unless you're extremely risk averse. Now, bonds might be a little bit more favorable here, but you're going to be subject to taxes again on that one. It's income after all. And so what can you do? Well, as a UK investor, actually, you can invest in a stocks and shares ISA. Now, you can deposit up to £20,000 a year tax-free, and this money can go as large as it wants. It's not like a pension scheme here. There is no cap on what size can be in the pot. So if you make your investments well, and you say deposit $20,000 a year, and you do that for 20 years, right? And you've had really, really good work on your investments, right? And you've deposited $400,000, but actually you've achieved an overall return over a 20-year period. That means you've now got over $1 million in the pot. You can withdraw that completely tax-free. So if you're investing in the stock market and you haven't even looked at stocks and shares ISA, that is the next thing you should do. If you go, well, okay, hang on here, Oz, I've got more than £20,000 a year to invest, and I'm in quite a fortunate position. What can I do here? Well, you should be looking at perhaps a self-invested personal pension, or SIPP. Now, this is advantageous, and it's basically means that your taxed money can get tax relief on deposit into the account. This is effectively a pension plan. It does have a limit or a cap of, I believe, about £1 million, and you have to be the minimum age of 55 or 57 from after 2028, and you can invest your money in here, and when you put the money or deposit the money in, it gets tax relief at source, and it's relative to the rate of tax that you pay. So if you're a higher rate taxpayer, you're going to see that same level of tax relief. You may need to jump for an additional hoop to request this with your stockbroker, and this allows you to deposit £40,000 per year. So again, this is a very good method of potentially dodging these taxes, or at least dodging the reductions in the allowances. And after all, if you've got more than £60,000 to invest per year, per financial year I might add, then I think you're going to have bigger problems than worrying about the overall taxes. For me, in my portfolio, obviously it's hit a little bit quite hard here. My portfolio is down 14%. You'll notice that my cash position has increased somewhat. I have added another top up in, and I've still not spent any of my cash. I'm waiting to find an appropriate price target for the companies that I'm interested in. There are some other companies that I've not mentioned at all on the channel before as well that I am interested in buying, but I'm just sitting patiently, which is probably the first time since I've created the portfolio that I'm truly sat here and being very calm about it. I can see Boohoo's share price has dropped. It flew all the way up to about 55 pence a share, and it's going back down to 43 pence a share. I'm trying to work out a fair valuation on the company given the current prospects and the overall fundamentals, so I'm really trying to set an appropriate price target. Same applies for Games Workshop. Again, I think Games Workshop is holding its value a little bit better, or definitely better than Boohoo at the moment, as they're sitting at about £73 a share, and I think realistically that puts them at a price to earnings ratio of about 18 times, which is slightly as of a premium to the market average, but I think overall at the moment the current price to earnings ratio of the UK markets is about 11 or 12 times. So again, that's very much a premium there compared to the overall markets. But then Games Workshop is a quality company, so there's a lot more evaluation that needs to be put in place there. I'm getting some more money next week, so I will be topping up more. I'm going to be accruing that 4% interest through my free trade plus, or it might be 3% interest, sorry. And I'm just going to keep that there for now. I'm going to see what's going to happen, can carry on investing, really work out these price targets, and hopefully going forward it'll improve. Now, what I'm also going to be doing is reworking the Patreon. I might even cancel the Patreon, but I'm going to set up a new way, because this whole live access thing, the spreadsheet alone, it looks pretty tacky. I'm going to be improving the spreadsheet. I'm currently working on it. My Excel skills have developed substantially since building this. So if you are interested in that, could you leave me a comment and just say, you know what, look, I'd like to see like a weekly email update on your portfolio, as well as obviously the videos, but you might get that on a Friday afternoon, Friday evening, for instance. You'll get a snapshot of all my positions, more detail, and you don't have to tune into all the videos for that. Anyway, have a fantastic day.